This episode is a rare opportunity to see how two of the most important themes in financial markets interact. On one hand is the access to private markets. On the other hand is the use of AI and data. And I'll be talking to Andrea Carnelli Dompe, whose company deals exactly with that. Their tagline is that they create AI agents for 10 times smarter limited partner operations. So before I go into that, I want to understand Andrea's background and how he came up with this idea.
My background is in quant finance, AI, machine learning, all those things put together. It started off as a PhD in quantitative finance, which is where I learned how to torture the data and extract interesting insights. I then got recruited by a large fund of funds business that was focused on private markets. The challenge there was to use all the data we were collecting to help our clients and investment teams make better investment decisions. And that was an incredible opportunity for me to learn about private markets, how they work, what the challenges are. And that's what led me to Tamarix, which is the company you just introduced. So at Tamarix, we help limited partners, allocators that invest in private market funds, such as private equity, venture capital, private debt, and so on and so forth. We help them make their operations 10 times more efficient thanks to the use of AI and AI agents.
So we're talking about an audience of LPs. So those are limited partners. But I would like to understand who are the people, who are the organization, from your perspective, that hide behind the acronym?
Yes, LPs is a very sort of broad term when you actually look at the institutions that lie behind it. Maybe let's go with the traditional LPs. These would be institutional investors that have been in private markets for decades. So think of pension funds, especially defined benefit pension funds, endowments and foundations, the endowments of universities or charitable foundations. You have fund of funds, so investors that are professional asset managers investing in the asset class. But increasingly, you also have family offices that could be multi-family offices or single family offices. And increasingly, you also have ultra high net worth individuals as part of the democratization trend in private markets that participate in the asset class as well. So it's a broad range.
So if we split this up between the institutional and the private wealth, can you tell us more about who are the players in this private wealth market?
I think family offices occupy a self-standing category that is probably closer to endowments and foundations. So at least the family offices I tend to deal with, they're incredibly sophisticated, institutionalized investors. And by that, I mean they have very sizable allocation as a percentage of private markets. They tend to write very large tickets. They do that directly with direct commitments to private market funds. They might have been in the asset class for decades as well, and therefore have built very strong relationships with leading GPs, and in some cases have also started doing secondaries or co-investments, just like any institutional investor might have. So I think family offices tend to be very institutionalized. The retail end is more, ultra high net worth individuals that might purchase private market products through their banks, through their wealth managers. So you bank with Bank X, and Bank X would probably sell you a feeder to invest in private markets, but it's all very much intermediated by the bank, all the way from reporting to the capital calls, and it tends to be a very small portion of the universe that is being offered to these ultra high net worth individuals. That's what I kind of think more of as being retail.
So we understand that lines can be blurred and that an LP may also one day participate in a feeder fund, but there's still a change between being an LP, and I think that's someone or an organization that leans in more and is a lot more active than being just a high net worth investor who has been advised by his financial advisor to put some money into a perpetual or feeder fund. Can we now discuss about the operational issues they face and how do you help them solve that with Tamarix?
I think ultimately an LP has to do certain mission critical activities. That is accounting, reporting, monitoring, making sure the GPs are doing their job, portfolio construction, so making sure you are managing the commitments in a way that manages your risk of liquidity and also achieves your portfolio construction goals. So all these things can be done if you have data from your underlying managers that is correctly collected, normalized, and processed. And this is where Tamarix comes in. We basically automate everything that has to do with data and workflows so that our clients can focus on the actually interesting side of investing in private markets.
So how does it work in practice? Let's say I've invested in different funds from different providers, different strategies. I get information from the vendors. What type of information do I get in what format and how do I process it?
So suppose you have made 20 fund investments. Every manager will have their own reports being shared through their own channels. So effectively what happens after making those investments is that every day you open your mailbox and you see a bunch of notifications. Some capital calls, some capital distributions, a new capital account statement, a new quarter report, a new K1. You have loads of documents being sent. Now, these documents hit your mailbox as a notification, but not necessarily do you find those documents as an attachment. So you typically then have to somehow recover the logins to the manager's portal, log into the portal, do the MFA, get the code on the phone, retrieve the document. And that's only to get the document itself. And yes, that document is a PDF. And that PDF will always be following different templates. Everybody reports differently. So you will download that PDF, look at it, and work out what kind of information you need to extract. Oh, is it a capital call? So I need to make sure I understand how much to wire by when. Oh, is it a capital account statement? Let me take the NAV and feed it to my reporting system so I can value the funds at the end of the month. Oh, it's a quarter report. Okay, so let me actually capture the data about the underlying company so I understand how this fund is building up exposures and risk. All of that process is typically very manual. And the outcome of that process is after you have tracked down the notification document, you have extracted the data, you have put it onto a sort of standardized format, is to actually then do everything you need to do afterwards. The monitoring, the reporting, all those processes I was talking about before. And that's usually done manually and on Excel.
So at this stage, we haven't yet spoken about doing any due diligence, performing analysis, applying some judgment. We're just talking about inputting in the system, but then the interesting part comes, right?
Correct. Then you will need to do the performance calculations, make sure the data is structured in a way that is accessible, run forecasting of it. That's where all the fun starts.
And that's not finished, right? You probably also need to report to your investors, deliver reports for the compliance, all of that and more.
Correct. That's the mix. And it all starts with data. So that's the core of what we focus on.
So what is the traditional approach to that? How have LPs dealt with it so far before the introduction of Tamarix?
Yeah, in most cases, it's manpower. The issue is that the data is so unstructured that until recently, it was just very hard to handle automatically. So it was manpower being thrown at a problem. As the industry has evolved, people started saying, okay, but let me just stick that data into a SaaS solution that allows me at least to query it afterwards in an efficient way. So then you had the next wave of evolution that was manpower feeding SaaS software. Now, thanks to AI agents, we are trying to automate also the manpower part feeding into the system.
So we've only spoken about the problem without speaking about the solution so far. Can you tell us where does Tamarix intervene, and is it as early as this phase of ingestion of data? And then how far do you go in the process?
We can support any kind of intervention in the value chain, but typically people will have preferences as to where we intervene. In the broadest sense, we can intervene already at the notification receipt level. So we can track notifications, recover the documents, extract the data, normalize it, and make it available on a software that also generates all the downstream analytics. All of that we can support. Then some people will open the menu and say, actually, I just need you here. And yeah, we can support that end to end.
And in practical terms, how do you insert yourself in this structure, in this process of communication between GPs and LPs?
Well, the source of information is GP portals. And GP portals tend to run on a few systems that are quite common across the industry, but there's loads of exceptions. And those systems are not necessarily known for being very tech-friendly or open to third-party systems. So unfortunately, it's a wide range of techniques, from having simulated logins to automated attachment extractions in the case that the notifications are sending the documents as attachments. There's loads of different strategies that are very specific to the GP portion.
And how do I implement this as an LP? What is the first step in order to move from my traditional approach to your AI agent-driven approach?
Typically, when somebody uses us for the end-to-end portfolio monitoring approach, it would all start by authorizing us to receive documents from GPs on their behalf. So that's step number one. Step number two would be tell us what you have so we can map out your portfolio. Step number three is explain to us what kind of accounting, monitoring, reporting flows you have so that we can design the system in a very scalable way that goes and ticks all those boxes. So, we understand what you need. Based on that, we work out what kind of raw data we need to extract and normalize. And on top of that, we work out also what kind of derived analytics you need. So we really start with the clients and end goals.
And is this a high-touch sort of consulting process, or do you have a way to automate it?
It sounds like a consultancy-like, but actually it's not. So we designed the system to be incredibly general and adaptable to different use cases. We are able to fine-tune it very well, but we are always using the same generalizable framework that we just roll out to new cases, which is one of our strengths. So it feels like it's just done for you, but it's not.
And how are your clients able to measure the increase in efficiency and improvement?
I think we have three main areas of impact. The first one is we reduce the amount of labor required for these tedious day-to-day tasks, which typically means that the people who used to do that are freed up to do something that is more value additive and value generating. So that's benefit number one. And that's in the order of, for say a portfolio of 50 100 funds, it's in the order of hundreds of hours per quarter. So that's a lot of time. Secondly, we reduce the risks of missed data or incorrectly extracted data, and that, depending on the downstream implications, can save a lot of money and effort. And thirdly, more broadly, we make the data more available, more quickly, more accurately in general. So typically clients not only automate what they have already, but are able through us to extract more data more promptly. And this is unlocking loads of new use cases. Classic example is look-through data. Some LPs are so sort of stretched to simply process the minimum bare necessary things, such as processing calls and working out valuations, that they kind of don't have the time and bandwidth to extract look-through information from their investments. But that's key to understand how your exposures are building up, where your performance is coming from, whether the GP is doing exactly what he said he would do. So there's loads of value that can be generated there. And typically when people come to us, since we make that information easily available, that's an extra edge that they gain to us.
So the conversation got a bit fixated on the process and the pipes. Ultimately, it's about spending more time on the things that matter the most, making better investment decisions, having clarity, and so on. And I would like to understand more the technology that you're using in order to deliver that.
First of all, there's lots of buzz around AI, of course. I like to always remind people why we think it's transformational for private markets beyond the buzzword. And the problem that AI solves specifically for private markets is exactly the problem of data being so siloed on different sources and being so inconsistent across formats. And AI is particularly well suited at dealing with this messiness of sources and formats. So that's the kind of real big reason why we are investing a lot in that direction. When it comes to agents specifically, it all boils down to the definition. So we kind of think of agents as being software systems that are smart enough to think for themselves and to make actions with some degree of independence and autonomy. And the key words here in this definition are autonomy and taking actions, making decisions, taking actions. Those are the two key ingredients. What makes them different from AI workflows or AI co-pilots? So the first wave of AI that we saw in the first years when everything changed in 2022. How do we design them then in practice? So I think we follow three principles. One is we hypertrain these agents to the private markets use case. I think horizontal agents that kind of do everything across different use cases and sectors are not as powerful as hypertraining the system to a very specific use case, vertical language, logic. So specifically in private markets, they need to understand the jargon, they need to understand the implications, they need to understand that 95% cold means that you can take the commitment, multiply by 95% and extract the value of cold. So there's lots of jargon that they need to understand and a lot of rules that they need to understand to be able to look at private markets data in an effective way. Just like somebody needs a long training at university and in the industry to actually appreciate what's inside this document. Same thing for agents. So that's one, hypertrained to private markets use case. Secondly, we like to be LLM agnostic. There's a lot of innovation happening in the market. There's a new release every week. Not all of those models are improvements versus the previous versions, first of all. Not all of those models are good at handling all tasks. So we have built a system that basically identifies at any point in time the best available LLM for the best use case and kind of integrates them all in a cohesive framework. So that's kind of principle number two. And principle number three is for mission critical tasks like finance in general, not just private markets, it's very important to have a very high level of accuracy. And the way we sort of cope with that is we make sure that we support fully a human in the loop for final decisions on critical action items. So we have thought about the system in a way that it becomes incredibly easy to audit what the AI has done, why, and how exactly it has made implications from documents so that it becomes very easy for a person to click, yeah, okay, I agree with this implication. And that is a massive component into the productivity gain, because I think a system where only 99% accurate, but not easily auditable, wouldn't save time at all, because somebody wouldn't trust it, wouldn't have an easy way to audit it, and would have to kind of do the job from scratch. So having that auditability, massively important.
That answer brings in two reflections. First of all, how different it is to use data to have a streamlined use of data in public versus private market. In public market, this has to some extent been solved. I mean, there's so much more to be done in terms of data and improving it, but accessing the data is already very advanced, whereas in private markets, there's so much to be done there, and therefore so much differentiating factors for those that play this game. And the second one is, I guess, more about building startups in general in this age where AI is everywhere. And I can totally get why being LLM agnostic is a good way to play this game, because there's so many resources that are being built and that are available pretty freely.
Absolutely. And the way we approached it was by basically building a massive backtesting framework, effectively. So we have this beautiful proprietary data set of documents coming from different GPs, different asset classes, different type of data contained. And we have the ground truth that we have been able to establish by working with our clients. Every time a new model comes out, we can very quickly check if using this model alongside the entire infrastructure that we have set up, so there's an element of interaction with our systems, but tell me very quickly if this new model can improve the performance of our systems, and tell me exactly where it improves it, where it does not improve it. And based on that, we can integrate that new model or totally discard it where it makes more sense in our architecture. And that's super powerful. Otherwise, every time a new announcement came out, we could be absolutely in the dark whether that is going to be helpful or not.
And that makes me reflect on something that I've seen from the CEO of Bright Data, and I will not quote him exactly, saying that the calculation power is always going to increase exponentially, but you can build data moats. And I guess by that he means accessing and processing the data is where you can really make a difference and a sustainable advantage for yourself?
Yeah, well, yes, I mean, at least from a pure technology perspective, precisely because these systems have to be highly trained to the domain to be really driving big efficiency gains. They will do okay if they're not trained. There's so much to be gained if you train them specifically on the domain that having access to the information in that domain is a moat for you because you'll be able to get a better mousetrap out of that versus somebody who doesn't have access to that data. And as you accumulate more data, you're going to have a quicker edge for sure. I think eventually that kind of advantage might level out. But as of today, it's all about gaining that data and optimizing the LLMs on that data.
And I guess it's also a technical perspective. It reminds me of the time when Uber was pretty much offering free rides and WeWork were incentivizing people to come in their offices with a lot of perks. I can see as well the evolution. Gmail, not so long ago, was trying to make me pay for the use of Gemini, and now they're trying to force it into my email account. It's a good opportunity that may not last forever.
Every single penny lost in P&L by one of the LLM providers is 1 cent gained by the consumers of those APIs.
What you're trying to reach and how much accuracy you're trying to reach. Are you aiming for 100%? Then it's probably going to be exhausting. Perhaps in what you do, if you're aiming for just 90%, then this 10% means that there's absolutely no efficiency. Whereas if you reach, let's say, 99%, then that's something that's really effective.
Absolutely. So I think the best way to look at it is in terms of time saved for the person overseeing process. It's a good proxy to think in terms of extraction accuracy, if you like, but it's just a proxy. And there comes a point where 1% of additional improvement doesn't really help the person because he still needs to check it. So we try to think in terms of time saved. Ultimately, that's what we want to optimize for.
Now I realize, Andrea, we also have to reflect on this democratization of alternatives, which is such a big topic, and investing in private assets. So you're talking to sophisticated people and make it easier for them, but it's also part of this democratization or enlarging the access. Now that you don't need that many resources, that's when you may be able to start in this very complicated world.
I think democratization could be great if done properly. So in principle, if you give more options, more investment options to a wider audience, the more people will be able to choose what's best for them. That's in theory. What's happening often, though, when it comes to democratizing private markets is that products are being pushed onto people who shouldn't really have it in their portfolios, owing to, say, liquidity and maturity constraints. And B, sometimes these products are mainly a way for some intermediaries to drive more fee generation. So if we reduce these opportunities for bad acting, I think democratization could be great, to be honest. But if instead these trends continue and people see it as a way to make more fees and push the wrong products to the wrong people, I think it's going to be a boomerang hitting the industry. So I'm kind of worried about it.
The democratization could be that you no longer need 20 people to really be an LP, a player in the game. That brings me to my final question, which I call the fantasy fintech question. How do you see private markets evolve in the best possible way in the near future if there's no constraints?
Well, I'll tell you how I would love it to evolve, as I think it should evolve in this way to be really value additive to the community of investors. I think, first of all, information should flow as it flows in public markets. It shouldn't be something hard to access and extract and understand. It should flow as easily as in public markets. So that's number one. Number two, we should make advances in having a unifying language to compare publics with privates, because as we insert these investments in broader portfolios, we need to understand the interactions. We need to understand when it makes sense to add private versus not. And we still lack a unifying language. There's massive debate simply of why IRRs are misleading. So that's point number two. Point number three, I see more secondaries as a day-to-day tool to exit positions you don't want anymore, just like in the stock market, just like in the fixed income market. Lower fees. I think private markets generally generate value, but I think oftentimes there's lots of fee capture, value capture from GPs. So I hope that the fees and carry will go down. And finally, back to your point before, responsible democratization. I think with all these things happening, private markets will be a great force of good for portfolios.
Okay, we probably need to do one episode for each of those 4 points, so 4 more. But that's a great conclusion. Thank you so much, Andrea. It's been a wonderful conversation. Perhaps you want to tell us as well what's the best way to find more information and contact you, and we will put all that in the description and the show notes of the podcast.
Yeah, fantastic. Well, it's been a pleasure. Thanks for the chat. I really enjoyed this. And yes, we have a website, of course, with a contact form. I'm very active on LinkedIn as well, so I typically monitor my messages. So either way is a good way to reach us.
Thank you very much, Andrea, and thanks very much for watching or listening to us.